This week, China sent shockwaves through the global auto industry with a bold and unexpected move. The Chinese government announced a sweeping 75% tariff on US-made electric vehicles, instantly raising the stakes in the ongoing trade war. This strategic escalation is designed to shield China's domestic market from foreign competition and to directly challenge America's ambitions in the automotive sector. The new tariff threatens to upend global supply chains, forcing companies to rethink sourcing and manufacturing strategies, and redefining the economic rivalry between the world's two largest economies. For US car makers, who have invested billions in electric mobility and innovation, this move creates a formidable barrier to accessing the world's largest and fastest-growing EV market. The steep levy makes American-made EVs nearly unaffordable for Chinese consumers, effectively closing a critical door for US exports and threatening future growth. This is a direct counterpunch to Washington's aggressive trade policies, escalating tensions, and creating a high-stakes standoff with global implications. The timing is no accident, coming as the US faces internal debates and policy shifts, including the rollback of subsidies meant to accelerate the EV transition. With international markets closing and competition intensifying, US automakers now face a tightening vice, putting jobs and investments at risk. At its core, this tariff is about control over the next generation of industrial technology, with China determined not to cede its dominant position in the global EV race. The conflict is already disrupting global manufacturing, driving up consumer prices, and forcing a fundamental reassessment of America's strategy in the rapidly evolving electric vehicle market. The 75% tariff is more than a trade barrier. It's a turning point that could have lasting effects, challenging America's leadership in the clean energy revolution and reshaping the future of global industry. China's rise in the EV world is no accident. It's a result of a decade-long strategy backed by $230 billion in government investment. China produces over 70% of the world's electric cars and dominates global sales. Companies like BYD have surpassed Tesla, signaling a shift in the technological landscape. Chinese firms focus on affordable, high-quality electric cars, capturing both domestic and emerging markets. China's control over the EV ecosystem, from mining to manufacturing, gives it a cost and production advantage. Chinese companies like KTL and BYD control nearly half of the global EV battery market. This vertical integration allows them to innovate faster and build cheaper cars than international rivals. China is setting a new standard for modern vehicles, further cementing its leadership in the automotive future. The US has responded to China's EV dominance with defensive measures, including a 100% tariff on Chinese-made EVs. This protectionist stance aims to shield the domestic auto industry. However, domestic policies have become confusing and contradictory. The One Big Beautiful Bill Act ended federal tax credits for most new EV purchases, creating uncertainty. Stringent battery sourcing rules have made American EVs more expensive for consumers. The withdrawal of government support has led to the cancellation of clean manufacturing projects. US policy now appears to be pulling in two different directions. The government's actions reflect anxiety about America's competitive position. Tariffs are intended to protect American jobs, but the rollback of support programs risks undermining the industry. The American response has created a turbulent landscape for an industry at a critical inflection point. The ongoing trade war has brought into sharp focus the US's deep dependence on China for critical electric vehicle materials. This reliance is not just a matter of economics, but a strategic vulnerability that shapes the future of American industry. The US relies heavily on imports for essential minerals like graphite, manganese, cobalt, and rare earth elements, materials that are the backbone of modern battery technology and clean energy solutions. China's dominance extends far beyond mining. Its control over the processing and refining stages gives it immense leverage, allowing it to dictate the flow and price of these vital resources on the global market. Even when the US sources raw minerals from allies, it lacks the domestic capacity to refine them into battery-grade materials. This gap leaves American manufacturers dependent on foreign processing, especially from China. China processes a significant portion of the world's graphite, cobalt, and lithium, making it the central hub for battery material supply chains worldwide. Building an independent American supply chain is a monumental task. It faces not only technical and financial challenges, but also regulatory hurdles and local opposition that can slow progress for years. In the short term, American automakers must navigate a supply chain that remains heavily influenced by China, making strategic planning and risk management more complex than ever. China's willingness to use this leverage is clear in its export permit requirements and sudden export halts, which can disrupt global supply overnight and send shockwaves through the industry. These actions serve as a stark reminder to the U.S. of its ongoing supply chain vulnerability, highlighting the urgent need for diversification and resilience. While the U.S. can block Chinese cars from entering its market, China holds the power to squeeze essential material supplies, impacting American manufacturing at its core. This creates a perilous situation for U.S. industry, putting entire production lines at risk and threatening jobs, innovation, and economic growth. The depth of America's supply chain vulnerability is a critical concern, one that will shape the nation's economic and strategic future for years to come. Chinese tariffs and shifting U.S. policies have put American automakers in a tough spot. The 75% tariff closes off a key growth market, forcing companies to recalibrate strategies. Exporting U.S.-made EVs to China is now commercially unviable. At home, the phasing out of subsidies has raised the cost of American EVs, dampening demand. Strict battery sourcing rules limit vehicle eligibility for incentives, slowing sales growth. Automakers are scaling back production targets and canceling factory projects. Some companies are pivoting back to hybrids, seen as a pragmatic bridge technology. This signals a retreat in the technological race, focusing on an intermediate step. The financial strain is palpable, with high domestic production costs and supply chain disruptions. U.S. automakers face a classic squeeze, determining the future of America's industrial base. China's formidable weapon in the automotive arsenal is price. Even with U.S. tariffs, Chinese EVs have a significant cost advantage. Chinese automakers produce EVs at a fraction of the cost of American counterparts. The price disparity is most glaring at the entry-level segment. The BYD Seagull retails for under $8,000 in China, while the cheapest U.S. EV starts at over $33,000. This affordability is a major reason why many Americans would consider buying a Chinese-made vehicle. China's dominance of the battery supply chain allows access to cheaper components. Chinese firms use lithium iron phosphate batteries, providing a cost edge. Lower labor costs and government subsidies further reduce financial burdens. Rapid innovation cycles allow Chinese companies to adapt quickly, maintaining their cost advantage. The trade dispute is evolving into a tit-for-tat economic conflict, with each side responding to the other's moves in rapid succession. What began as a disagreement over trade imbalances has now spiraled into a much broader confrontation, impacting industries and consumers on both sides of the Pacific. The U.S. imposed a 100% tariff on Chinese vehicles, met by China's 75% tariff on U.S. EVs. These steep tariffs are not just numbers, they translate into higher prices for consumers and shrinking markets for automakers, threatening jobs and investments. The conflict now includes critical raw materials and components, raising stakes. Electronics, batteries, and green technologies all depend on these vital inputs, making the dispute far more consequential for the global economy. China's control over the global supply chain for minerals is a powerful retaliatory tool. With dominance in mining and processing, China can influence the flow of essential resources worldwide. Export permit requirements for graphite and halts on rare earth elements are forms of economic warfare. These measures disrupt manufacturing far beyond China's borders, sending shockwaves through international supply chains. These actions pressure American industries and demonstrate the cost of protectionist policies. Factories face delays, workers worry about layoffs, and companies scramble to adapt to the new reality. The U.S. must scramble for alternative sources, driving up production costs. Sourcing minerals from other countries is expensive and time-consuming, putting American manufacturers at a disadvantage. The message is clear: if the U.S. builds a wall, China can stop sending essential materials. This standoff highlights the risks of economic isolation in a deeply interconnected world. Other economic blocs are forced to choose sides or enact protective measures. The ripple effects of this conflict reach far beyond the U.S. and China, affecting global alliances and trade policies. The tit-for-tat measures create global ripple effects, fracturing the international trading system. Uncertainty grows as businesses and governments brace for further disruptions. The world is moving toward regional economic blocs and heightened competition, as countries seek security in alliances and local supply chains. The era of easy global trade is giving way to a new, more fragmented landscape. The US-China tariff war has pushed both nations to a critical crossroads. The dream of a seamlessly integrated global economy is fading, replaced by a fragmented world. The central question is whether this path leads to renewed domestic strength or prolonged conflict. The US faces immense challenges in competing with China's manufacturing might. The pivot toward hybrids suggests a crisis of confidence in winning the EV race. Losing the EV race means ceding strategic influence to a geopolitical rival. American consumers and dealers add complexity, with many open to Chinese EVs. This creates tension between protectionist goals and consumer desires for lower prices. The conflict forces both countries to confront difficult choices about industrial strategy. The trajectory points toward greater rivalry and economic decoupling. The future of the US-China relationship may be decided in car showrooms worldwide.